In this lesson, we're going to review the acquisition transaction in a business combination and the consolidating entry immediately after. Here, the parent will purchase 100% of the subsidiary and we will have a bargain purchase gain. We'll break down the acquisition entry into 3 basic items. First, the sub's book value. Second, the sub's fair value. And third, the purchase price paid. If you consistently start acquisitions with these 3 items every time, the rest of the calculations are easy. Then, to consolidate the acquisition, we go to our acquisition 3 steps. Step 1, out with subs equity. Step 2, mark to market and access to Goodwill. And step 3, get rid of the investment and establish the non-controlling interest. With that in mind, let's go to the board. First, read the question. Then, as you read through the prompt, you can keep what you need and throw out what you don't. The question reads, what amount of gain should plant report related to this transaction? So we're looking for a gain. Make a note on the top of your board. Now let's go to the rest of the prompt. Plant purchased 100% of the outstanding common stock of Seed in an acquisition by issuing 20,000 shares of its $1 par. That had a fair value of $10 per share on the acquisition date. On the acquisition date, Seed had assets with a book value of $200,000, a fair value of $350,000, and related liabilities with a book and fair value of $70,000. What amount of gain should Plant report related to this transaction? That was a mouthful. Don't be intimidated by the sheer number of words. Just break it down sentence by sentence. Plant purchased 100% of Seed. Start with the picture. Write P and S and the percentage. Now we can see who's who. Let's start with the acquisition by setting up for our calculations. First, book value on the bottom, then fair value in the middle, and purchase price at the top. And note the percentage 100%. Let's start from the bottom. How much is the book value of Seed Company? Here, they don't just give us book value. That means we have to work for it. Book value of a company is calculated as assets minus liabilities. That also means net assets, and it also means stockholders' equity. So keep in mind that those all mean the same thing, book value. They give us assets and liabilities so we can compute Seed's book value. Book value of Seed's assets is $200,000, less book value of Seed's liabilities is $70,000. That equals $130,000. Next, let's do Seed's fair value. Once again, they don't just give us fair value of Seed, we have to work for it. Fair value of Seed's assets is $350, less fair value of Seed's liabilities is $70. That equals $280. Third, the purchase price paid. Plant paid using 20,000 shares of $10 per share. Why do we use this $10 fair value rather than the $1 par value? Theoretically, if Plant wanted, it could have gone to the stock market and sold its shares for $10 each and then paid for Seed with that cash. Par value really doesn't mean much of anything. It's a made-up accounting and legal term, but has nothing to do with real-life value. So 20,000 shares times $10 per share equals $200,000. Note the difference between book value and fair value as mark to market. This is the amount that we have to record to get Seed's assets and liabilities to fair value. Seed bought its assets at historical cost a long time ago. Let's say it owned buildings in Manhattan for decades. Those buildings are going to be worth a lot more today than whatever Seed bought them at. We don't care about the historical cost from 100 years ago. We care about what Plant bought it for today, the acquisition date. Conservatism does not allow Seed to mark up its assets on its own. But now that Plant theoretically bought all of Seed's assets and liabilities when it bought Seed, Seed's assets now get marked up to fair value on parent's financials. So $280,000 fair value less $130,000 book value equals $150,000. We have to mark up the assets to fair value by $150,000. The liabilities are the same for book value and fair value and do not require adjusting. Next, calculate the difference between fair value and the purchase price as goodwill. In a previous lesson, we defined goodwill as the excess of the 100% purchase price over the 100% fair value. Here we have the opposite. The purchase price is smaller than the fair value of the sub. This is the opposite of goodwill, and we call it a bargain purchase gain. Here, the 100% purchase price is $200,000, less the 100% fair value of $280,000. The purchase price is $80,000 less than the fair value of Seed. We record the bargain purchase gain as $80,000. Let's read the question again. What amount of gain should Plant report related to this transaction? And now we have the answer, $80,000. Let's do the journal entries for completeness. Let's start with Plant's entry at acquisition. For sales and purchases, think of the transaction as what are we getting and what are we giving? Which one is the best indicator of fair value? For bargain purchase transactions, there's generally a reason why the subsidiary is being sold below fair value. The sub may be in need of cash to continue its operations, or the sub must be sold by a certain date. Generally, subs owners have their backs up against the wall, so usually the purchase price is not the best indicator of fair value of the transaction. Then what do we use? The fair value of the sub's assets and liabilities, what we're getting. Let's see how this plays into our journal entry. Plant is issuing $200,000 worth of common stock. Common stock is an equity account and it's increasing. That's a credit. How much is it for? Remember, common stock only includes par. Plant issues 20,000 shares with a $1 par. 20,000 shares times $1 per share equals 20,000. Where does the rest of the 200,000 go? Additional paid in capital. APIC is an equity account and it's increasing. That's a credit. And the amount is the fair value of the stock, 200,000 less the 20,000 already recorded in common stock. That equals 180,000. Now, what's the other side of the entry? What did we get from this purchase? Investment in seed. Think back to investments. When we buy into another company, we record it as an investment, which is an asset. It's an asset and it's increasing. Then it's a debit. How much is our investment? Remember, when we have a bargain purchase gain, seed's owners, the shareholders, have their backs up against the wall. So rather than the purchase price paid, we use the fair value of seed's assets and liabilities, which is the better indicator of fair value of the acquisition. Here, that's 280,000. Now, do our debits equal our credits? Nope. How much are we off by? 80,000. And it's on the credit side. What's the account? Gain. It's the bargain purchase gain. That makes sense. Plant is only paying 200,000, but is getting an asset worth 280,000. Plant wins. It's a gain. Now, what does seed record? Did seed give or get anything in this transaction? The prompt says that Plant purchased the outstanding stock of seed. It does not say that seed issued stock. Plant bought seed's shares from seed's owners, the shareholders. It was a transaction between Plant and seed's shareholders. This has nothing to do with seed. That means that seed records nothing. Now, to consolidate the acquisition, we go to our acquisition 3-step. Step 1, out with sub's equity. Think of it like this. Plant bought seed's common stock, which is equity. When Plant and seed are separate entities with separate financials, that's fine. But now Plant and seed are together as one entity, and you can't own a part of yourself. So you have to get rid of all of seed's equity because it's owned by Plant itself. In this example, they don't give us seed's individual equity accounts, like common stock, APIC, or retained earnings. But we do know the aggregate amount, which is just seed's book value, and also equals seed's equity, 130,000. Equity is a normal balance of credit, so to get rid of it, we have to debit equity of sub. Next, step 2, mark to market and excess to goodwill. What adjustments need to be made to mark to market? Seed's liabilities are the same for book value and fair value. No change there. Seed's assets are different for book value and fair value. The assets increase by 150,000. When assets increase, that's a debit. The excess goes to goodwill, but we don't have any goodwill because the purchase price was less than the fair value of seed. Instead, we have a bargain purchase gain, which Plant already recorded in its acquisition entry. Now, what's the other side of the entry? Adding up our debits, 130 plus 150 equals 280. We know the credits equal 280. Where's it going? Here's step 3. Get rid of the investment. The investment in seed balance is 280,000. The investment is an asset, so to get rid of it, we have to credit. Why do we get rid of the investment? Remember, consolidating, that means in its simplest form, we're adding Plant's cash and seed's cash together to get total consolidated cash. And the investment account represents Plant buying seed, the company. In essence, the fair value of all of seed's assets and liabilities. So if the investment account already includes seed's assets and liabilities, and we're adding each of seed's assets and liabilities onto the consolidated financial statements, then effectively Plant would be double counting on its consolidated financials, once in each line item and again in the investment account. So we have to get rid of the investment account to avoid double counting. And finally, here there's no non-controlling interest. Plant purchased 100%, all of seed. Non-controlling interest only comes in when the parent buys less than 100%. Do our debits equal our credits now? Yep, done. Let's take a look at what we're left with after the consolidating journal entry. Step 1, out with subs equity. Seed's equity is now 0. That means that on the consolidated financial statements, only Plant's equity remains, and that's what you want. Step 2, mark to market and excess to Goodwill. We mark to market all of Seed's assets and liabilities. So on Plant's consolidated financials, all of Seed's assets and liabilities are now shown at fair value. And we didn't have any Goodwill here. We actually had the opposite, a bargain purchase gain. Lastly, we got rid of the investment account. It is now at 0 to avoid double counting. For acquisitions and the consolidation of the acquisition entry, just remember, first draw the picture, P, S, and the ownership percentage. Then start with the acquisition by setting up for your calculations. Book value on the bottom, fair value in the middle, and purchase price at the top. The difference between book value and fair value, you mark to market. The difference between fair value and purchase price goes to Goodwill, unless the purchase price is less than the fair value of the sub. In that case, the parent records a bargain purchase gain. And then to consolidate, go to the acquisition 3-step. First, out with subs equity. Second, mark to market and excess to Goodwill. Third, get rid of the investment and establish non-controlling interest. Up next, we're going to see what happens when the parent buys less than 100% of the sub. How do we account for that non-controlling interest? You want to be sure to hit these points on the exam, so don't go away. I'm Liz Cho with Test Prep in a Snap.